So it is your dream to reach a portfolio value of $1 million and one day be able to live off dividends. But how do you get to that point? How much do you have to invest and how frequently do you have to invest? Well, first of all, let me tell you, it is probably not as hard as you think. Let's take an example. If you were to invest $300 a month into the SCHD, which has an annual return of 11%, it would take you about 10 years to reach a portfolio value of 100k. But now you are probably thinking, if it took me 10 years to reach 100,000, it will take me 100 years to reach a value of $1 million. Well, what if I told you that that is completely false? If you invest at this rate, $100,000 is actually a third of the way to reaching a value of $1 million, and that is thanks to the compounding effect and reinvesting your dividends. To reach a value of $200,000 from this point, it would take you only an additional 5 years. To go from $200,000 to $300,000, it would take you 3.5 years, and so on, until to go from $900,000 to $1 million, it would take you only 3/4 of a year. So in the 30-year period of investing, at the start it took you 10 years to build a value of 100k, and by the end of the 30 years it took you only 9 months. But at what rate should you invest and reinvest your dividends to maximize your returns? Well, to figure this out, let's jump to scenario 1. And in this scenario, we will invest into the SCHD, which has a year-over-year dividend growth of about 11% and a year-over-year price growth of about 11.5%. We will make an initial investment of $10,000 and after that every single month invest another $300. Now in this scenario we will reinvest dividends as soon as they are paid out, so quarterly. This is very important. And of course these models also account for inflation. So if we follow the rules I just listed, it would take us 30 years to reach a value of $1 million. You can see the blue line below, which is the total amount we have invested. It is growing linearly, while our portfolio value is growing exponentially thanks to the compounding effect. You can also see the graph to the right, which shows how much dividends you would generate if you were to reinvest them quarterly. By the end of the 30-year period, you would have generated about $276,000 in dividends. And this translates to monthly dividend income of $5,300, accounting for inflation. And so this investing strategy would in 30 years allow you to live off dividends. Below we can see some of the numbers. In 30 years this portfolio would generate $884,000 in pure profit, so all you would invest is $118,000 to reach a value of $1 million. Now what if you made a small change to your investing strategy and instead of quarterly invested and reinvested your dividends yearly? If I jump to the second scenario, you can see all the values stay the same. We are still investing into the SCHD. We have an initial investment of 10k and a yearly investment of $3,600, which is 12 times 300. If we have a look at the graph below, in the same 30-year period, our portfolio would be worth only $780,000, almost a quarter less than the previous example. You can see that the total amount invested is the same in both examples, $118,000. The amount in dividend would also lower to $213k. So now after the 30-year period, you would be making only $4,300 in monthly dividend income, which of course you can still live off, but it certainly would be nice to have an additional $1,000. Now you are probably wondering why such a small change in your investing strategy can have such a huge impact, and in 30 years lower your portfolio value by almost 25%. Well, if you invest and reinvest your dividends quarterly, the first investment has an additional 9 months to grow, the second has 6, and the third has 3. That's an additional 1.5 years of growth every year for the 30-year period, compared to when you invest only after a year, where there is no such additional time to grow your investment.